RSI is not what you think. The RSI is like tracking your coffee intake. Above 70, too much caffeine. Overbought, very jittery. Below 30, not enough coffee. Oversold, very sluggish. We're doing a deep dive in this video into the relative strength indicator. Do you buy when oversold? Sell when overbought? It's actually not that simple. We'll give you a full breakdown and tell you how it can help improve your trading strategy. RSI is a momentum oscillator that measures the speed and change of price movements, helping traders identify potential reversal points. The RSI is calculated using this formula. RSI equals 100 minus 100 divided by 1 plus RS. Let's take a closer look. RS is the average gain of up periods divided by the average loss of down periods over a specified time. For instance, over a 14-day period, if a stock has average gains of 6 green days and average losses of 2 red days, the RS would be 3, leading to an RSI calculation of approximately 75.
You'll see the RSI plotted below the price chart. Notice how it oscillates between 0 and 100, providing visual cues for overbought, represented by a reading of anything above 70, and oversold, a reading of anything below 30. In comparison, a moving average, for example, indicates the trend direction. For a detailed analysis of moving averages, watch our previous video, link in the description. The RSI specifically measures momentum, giving traders an opportunity for better timing at pinpointing potential reversal areas where the current move may run out of steam. To effectively use the RSI, look for situations where the indicator crosses above the 70 to signal overbought conditions, or below the 30 for oversold. Meaning, let's say you combine RSI with moving averages. If you buy a stock because it's above the moving average, a possible trade setup is to sell or take profits in that position once the RSI reaches overbought territory. Now let's go even deeper. The more advanced and arguably more accurate method to use RSI is to look for divergence, both bullish and bearish. For bullish divergence, price is stable or slightly declining and the RSI indicator is actually making higher lows, indicating potential underlying strength and that a move higher may be coming. We can then also apply the same theory in the opposite direction to find potential underlying weakness in a stock.
On this 1-minute Palantir chart, we're using the relative strength index, the RSI, for entry and exit points. What's our entry strategy? When the RSI drops to 25, indicating an oversold condition, we buy that dip. In this example, we entered around 9:30, catching the bottom perfectly. Our exit strategy, we watch for the RSI to reach 70 to 75, signaling potential overbought conditions. At 10 and at 11, we scaled out of our positions as the RSI hit these levels, capturing our gains before potential reversal. What are the key takeaways? Use RSI 25 level for buy opportunities and the 70 to 75 level for selling or reducing positions. This method works effectively for quick, scalable trades on volatile stocks.